Greetings on behalf of Tim Kimmel, Adam Jordan, and myself. We're happy to see you all here. You know, we're in for a treat. This is a very timely event. Welcome to our client education series. This is on tariff and trade wars. You know, we chose to accelerate this event just because of the urgency and timeliness of what we're going to talk about. Just as a way of background, this is our 9th event in our client education series. We rolled that out in February 2023. And the whole idea is to provide you with important information about strategies, timely information about the markets and the economy, as well as information that would be valuable to you. You may have been to some of the other events before on Medicare, Social Security, estate planning. But you know, we're happy to present this right now. And we've got, just for your information, have 161 registered viewers with over 200 attending in 12 different states today. So thank you very much for your attention. I think you'll find this very valuable. You know, in a moment, I'm going to turn this over to Tim Kimmel as your moderator. But as an introduction, what I thought I'd like to do is just think about the current news of the day. And, you know, as I thought about that, and I thought more about how I was reacting, maybe how you're reacting, the news and the headlines are enough to cause concern on a lot of levels, concern about the economy, concern about the markets, and concerned about your own financial security. By the way, that's what prompted this event at this time. Let me give you a sample of, this is just today's Wall Street Journal, by the way, March 25th. Headlines, front page, barriers to global trade rise at a pace not seen in decades. Now, also on the front page, different topic, but still a bit unnerving, Social Security's cuts to services and staff fuel anger and frustration. Now, just to show you, there's some contradictory news. As I go into the second page, same paper, by the way, it says this: the economic gauges show expansion in March activity, pointing to a positive outlook. So it's confusing at best. And then as I dug a little deeper into the same issue, what the Wall Street Journal did, and this is indicative of many other sources, all that are reporting about this. But what it did, it simply said, how are 5 investors dealing with the chaotic market? And just took 5 investors and different approaches. So let me go ahead and read very briefly what these 5 different approaches are. Now, we're going to talk more about this, obviously. Investor number 1 says, I'm buying more stocks, buying up stocks. Number 2, I'm leaving the US behind. In other words, going more global. Number 3 says I'm staying the course. And number 4 says I'm finding safe havens. And number 5 says I'm looking for opportunity. Now, I know those have probably all crossed your mind in one form or another. Well, we're here to unpack some of this and really provide some perspective, especially as it relates to your portfolio, the markets, and the economy. So you're in for a very informative time. And with that, I'm going to turn it over to Tim as your moderator.
Great. Thank you, Paul. Appreciate that introduction. And hey, welcome everybody. Good afternoon on a beautiful day. It's supposed to be 70 degrees. Thank you for taking time out of your schedules to join us. As Paul mentioned, very timely, very obviously everything's in the news these days with all the changes and things occurring. And so we just felt like, hey, this would be a topic that would strike a chord. And sure enough, it has. We've got a great turnout. And again, we just thank you for spending an hour or so with our time. My name is Tim Kimmel. For those of you that don't know me, I've been here at Paul Ried Financial Group for 33 years, and been having the pleasure of working with a lot of you. And for those of you that I don't meet directly with, obviously I'm certainly aware, familiar of you, and have had obviously some exposure through the years. So been a pleasure. But again, these meetings, these are called our education planning meetings, right? It's part of our PEAK program. PEAK is an acronym. PEAK, P stands for planning, E for education, A for advice, C is for consulting. So again, all of you have gone through this process, and this is just part of our educational series. So we've done a number of events on various topics. We felt, again, topic today on the economy was particularly pertinent. And so again, like Paul mentioned, really what we want to do is kind of try to unpack some of the uncertainty, some of the questions, obviously, that are on a lot of your minds, and trying to make sense of it all. So Before we kind of get into some of this, though, I do want to kind of go through a few logistics. Our meeting today, our time today is going to be about 45 minutes to an hour. It's going to be broken into kind of three sections. The first section is going to be some prepared content from Adam, our Director of Investments. Adam does a deep dive into our actual investment strategies. He talks directly with the managers on a daily, weekly, monthly basis. Not a week goes by that Adam isn't talking to probably 2 or 3 different fund managers and overseeing what's going on economically with the news, but also related to the investments underlying that we have within your portfolios. So Adam's going to do a couple of historical slides, talk about markets, volatility, drawdowns, some little historical perspective, like I said. That's going to be the first segment. The next segment is going to be just some of the questions that we're fielding from you in our meetings and from phone calls. We've broken out what I'll say is the top 5 questions that we're getting. And again, that might cover some of your questions. Again, we're feeling like, hey, if we're getting these questions frequently, other people have them as well. So we want to make sure we kind of cover those. So that'll be kind of a little bit of a roundtable between Adam, Paul, and myself. And then the last segment is going to be just an open Q&A, right? So this is going to be for you to ask any questions that you have. We will try to get to most of those questions, but if we can't, then we'll have somebody on our team reach out to you after our session and address your questions specifically. So again, we'll try to get through all this and try to, again, answer a lot of the questions that are outstanding. If you have questions on how to ask a question, let's talk about that now. There is a Q&A icon at the bottom of your screen if you scroll across your screen. So just click on that box, type in your question. I'll be kind of fielding those questions throughout our session. And then, like I said, the last 10, 15 minutes of our time, I'll be presenting those questions to the roundtable, and either Paul or myself or Adam will address them, or maybe we'll kind of all comment on them, depending upon the content there. So anyway, without further ado, right now that we've got some of the logistics out of the way, I want to bring in Adam Jordan and Paul Ried to our conversation here. And Adam, just for many of you, Adam is, like I said, dives deep into our investment management philosophy and our process, talks to money managers. Adam does a lot of speaking across the country, also nationally and internationally. He's done a fund forum presentation, I think the last, Adam, 4 or 5 years, 5, 6 years even, which has held different parts of the world over time. And so Adam is, again, a gifted speaker, very good at kind of unpacking some difficult things and kind of bringing that down, condensing it down to a fund level and a personal level. So good to have Adam. And then Paul Ried. No introduction needed for Paul, but Paul's the CEO and founder of our firm, of course. And again, we'll, for many of you, if you don't know, Paul founded the firm back in 1986. And again, has grown the firm over time, and I know has been integral in a lot of your lives. So Adam, I'm going to turn it over to you, and then Paul and I will come back in on the formal Q&A with our thoughts. But Adam, please take it over.
Perfect. Thank you, Tim. I'm going to jump into some things here, like Tim mentioned, talking about, all these issues that are going on as far as after the election. We saw some strong movements in the markets, and then essentially right after the inauguration, we pretty much saw the volatility tick in as people are trying to digest all this information, make sense of the different policies. Everything kind of, is almost seeming like it's in fast forward nowadays. Every day it's something new in the news, as Paul was mentioning, going through the newspaper, conflicting views. Markets, again, we all know that don't really like uncertainty. And, when the news is changing every day, this really does cause a lot of uncertainty, but the market's kind of, making its way through these things. I do have some slides I want to share, but at the end of this, as Tim mentioned, we're going to dive into all the actual questions on these policies, what the tariffs mean and all that. But so I'll actually start sharing this slide here. What this is basically trying to tell us here is we're seeing these news. we're seeing the talk of, you watch, maybe it's a CNBC. I hope maybe you don't, because it's probably just adds to those stress levels that we have. But we know we all turn it on. It's talking about the S&P 500. And, just I think about 1 or 2 weeks ago, we hit what they would call correction territory, quote unquote. So just for people to kind of refresher on what the news is talking about when they talk about corrections versus bear markets. Corrections are essentially defined as when the S&P 500, when it falls at least 10% from an all-time high, that would be considered a correction. So if you see kind of in this chart that down over 10%, anything over 10% is a correction. When it gets over 20% down from an all-time high, that's when they kind of consider that a bear market. And again, these are kind of arbitrary thresholds that have kind of just been agreed upon by everybody. But what this is trying to show is these are not, when we hear that, we entered a correction 2 weeks ago, again, we've kind of rallied back from that point. So we were only in a correction for 1 day this year, because we only went below that 10% threshold for a day. But so it's quick, but again, things could pull back further. But that kind of feeling of being down 10%, trying to put it in perspective of, this goes back, this chart here is showing you every day, every trading day since 1950. So we're looking at the past 75 years of the markets. How was our emotions feeling when we're going online to our portal, maybe looking up at your account value? And what this kind of shows is very rarely are you feeling like, well, we're hitting some new all-time highs. We're higher. I was higher now than I was yesterday. Because as we can see, historically, you're only hitting an all-time high about 8% of the time. Most of the time, you're hitting a new high, maybe pulling back into these down 0 to 10% ranges. So one thing we always like to tell clients is, it's important to be informed on your investments, but sometimes if you're just logging in every day, and that could, the news is stressful enough, sometimes when you're looking at your account values, and again, it's kind of a behavioral, I would call it behavioral biases that we all kind of have, and that's kind of anchoring to certain values. So it's often, if you're to log in all the time and see that you're not at the highest value, that's kind of, that doesn't necessarily make you feel the best, or maybe you're down 10% from an all-time high. Again, this chart is just the S&P 500. You all have diversified portfolios. So we have foundation and growth. We got your dynamic alternatives, which are areas that can be more flexible. This is just looking at if you're 100% invested in the S&P 500, which again is not a strategy we would necessarily recommend. We do believe in diversification. So another thing to be aware of when you're hearing on the news, oh, the S&P 500 has entered correction territory, down 10%. That doesn't necessarily mean your portfolio is down 10%, and definitely would not be the case, kind of in this year. But one thing I would mention, and when we're talking about percent of trading days, that only 8% you're hitting all-time highs. As we back up and think about this, well, maybe I just check this, every 6 months or every year or something like that. While only 8% of trading days are hitting all-time highs, if you're to look at what percent of calendar years you actually hit a new all-time high, it's like 64%. So it's almost 2/3 of the time each year the market's hitting new all-time highs. So again, kind of, we take a step back, we are hitting all-time highs traditionally a lot more frequently. But again, decade by decade, those kind of things change. Obviously, if we were invested in the 1990s, people felt like a new all-time high was all the time. And actually, I was actually looking up this stat for the 1990s, And so that was kind of, we had two extreme decades, 1990s and the 2000s. And in the 1990s, actually, you were only below an all-time high by 10%. That's 6% of the time. So it was a very dramatic kind of risk on period. And then obviously we had the 2000s when we were actually only hit all-time highs. That was actually called the lost decade, where we were only kind of hit the all-time highs in the beginning of 2000 and 2007 before kind of the financial crisis. But again, this is the S&P 500 versus a diversified portfolio did much better. It was not a lost decade if you were thinking in terms of a diversified portfolio of, balance between foundation and growth. But again, just wanted to kind of show this because as we go on, this is, 1/3 of the time, it's definitely expected that you could kind of feel like you're in correction territory, that there are bear markets, they come and go. But again, 2/3 of the time, 2/3 of calendar years, we're actually hitting new all-time highs. So just be aware of that. And if we bring that out, if we look a little bit deeper, again, tons of numbers going on here. Don't kind of get lost in it. I'll talk you through what this is talking about. But if we look at the gray lines here, those are calendar year returns. Again, this is the S&P 500, not necessarily diversified portfolios, but this is just showing you calendar year returns for the S&P 500 going back to 1980. That's in the gray line. That's where the return ended the year. What all these red dots are showing you is kind of that pullback that you experienced during the year. So this is essentially showing you, if we look at this year, so year to date, this is as of yesterday, the S&P 500 is down about 2% from its starting point of the year, but we had that 10% drawdown. Again, the year-to-date return wasn't down 10, but remember the market actually started off somewhat in a positive mood. Market actually got up to about 4% for the year, and then we had that 10% pullback. So we're still about 6% off from the all-time high, but again, if you look year by year, these 10% pullbacks are much more common than you can imagine. Last year we had an 8% correction. It was kind of during the summertime. And so we can see year by year, even when we have some dramatic, if we all remember COVID, it's amazing that it's 5 years ago now, or just over 5 years ago now, or almost exactly. Actually, we look at it 2 days ago was 5 years. So March 23rd, 2020 was actually the bottom of the market during COVID. So think about that. If we think about, so here we are, this is a COVID year. I don't know if you guys can see my arrow, but the year where we have the negative 34%. So that's when the market pulled back 34%. So we went from February 19th, 2020, and in essentially just over a month, so by March 23rd, the market had fallen 34%. And just think, everyone's emotions during the time, essentially the economy everyone was shutting down, global travel was coming to a halt. People could think nothing but, negative ideas about, the uncertainty that this means. But yet the year ended up 16% for the year. And actually, this is somewhat conservative because these gray charts, these gray lines actually don't even include dividends. So you'd probably add about 2 to 3% to most of these, depending on what the dividends were that year. But market ended up in what we could imagine as the worst kind of situation for a global economy, ended up 16%. Obviously, that was a lot to do with the stimulus measures and actions that went into place. But again, that's why we don't want to make dramatic moves one way or another, because we don't know what government policies are going to end up being. We don't know what that's going to mean necessarily for the markets, because again, a lot of the big companies back in 2020, those, think about all the Microsoft, Googles, a lot of small businesses were dramatically hurt during COVID. But if you think about the businesses of those big companies, those were not as severely impacted earnings wise as it was devastating for small businesses over the time. But again, just show this to show you that while times can look bad, even over here in 2011, when we had kind of the international Greek debt, European debt crisis, markets pulled back 19%. Again, still ended the year flat. So, and actually slightly positive, including dividends. So again, these are normal pullbacks. You never know when it could turn into a deeper correction. But that's kind of the point of why we build diversified portfolios. One, to shield you from these extremes, because obviously, a diversified portfolio should be shielding you. The purpose, obviously, is to not avoid losses, but to make them shallower, and so that we need less recovery. Because if we remember, like here in the pullback, and actually in 2008, the calendar year pullback was 49%. But if we remember, from the very peak to the bottom, it was about 57% loss over that time period. Obviously, diversified portfolios made to shield you from some of that, because if you lose 50%, you don't need 50% to get back to even. You need 100% to get back to even. And so kind of building in that protection so that we have a smoother ride and can meet the long-term objectives. So just important to keep these things in mind. Again, I'll kind of talk through what we're doing here, because we always think about what's going to be. All right, markets pulled back 10%. Obviously, markets have rallied since then, but people are wondering, is there going to be a recession? I'm not going to talk about that at this point yet. I know that's going to be in our questions, but people are wondering, is kind of all these government, layoffs, are these tariffs uncertainties, could this possibly lead to a recession? It's important also to remember that markets are forward-looking, and so even if you could correctly time the start of a recession and the end of the recession, that wouldn't necessarily protect you from the volatility surrounding those recessions. And if we actually look at it, even if you were perfect at seeing the turning points in the economy, actually the average return during recessions themselves has been positive on average. Again, just averages. You can see there's some time periods when the market has pulled back during the actual recession. But if we actually look at the numbers on it, and the reason this is because the markets actually peak on average about 6 months before the recession starts. Again, that's on average. Sometimes, like in 2020, the market peaked the same month. It was a very short recession, and people may wonder, well, how is that? How is the COVID period such a short recession? I think it's important to remember what a recession is. A recession doesn't mean the beginning of a recession doesn't mean things are bad, and the end of the recession doesn't mean things stopped being bad. Recession just means things are getting worse. Things are receding. So if we think about, when people always talk about, well, we can't be in a recession, or a recession can't be starting right now. Look at how low unemployment is. We're in 4% unemployment. Look at consumer spending or these other metrics. The reality is recession just means it's getting worse from a point. So actually most recessions start at very low unemployment. So the recession is when it starts receding and the end of the recession is this when things stop getting worse. Not that they're, because remember, the unemployment rate was quite high well after, as we see, the recession ended in April 2020. Our unemployment was in double digits far longer than that. But again, things stopped getting worse, and that is the definition of the end of a recession. And so historically, if we think about it, the markets actually in the past, and again, just on average, have peaked about 6 months before the start of a recession and actually start recovering about 4 months before the recession ends. So again, markets are kind of forward looking and they're trying to pick up on those indicators. And we can't really listen also to if we don't know, the National Bureau of Economic Research. They're the ones that officially date these recessions. And it's important to know we also can't wait for their official declaration of a recession either, because if we actually look at the history of how long it's actually taken them, they usually don't even announce a recession until about 7 months after it's already started. And they actually don't announce the end of the recession. I believe it is about, we got about 17 months on average after the recession ends. Will they even announce the end of the recession? So again, listening for official, if someone wants to get out of the market and wait till the all clear is announced, that's 17 months after the recession's over. And as we'll see here, the market's already rallied dramatically in that amount of time. This chart is essentially showing you every recession. Now, again, the last chart I was just showing you the returns during the actual recession itself. In this one, these orange lines are essentially showing you the total loss from peak to trough around a recession date. Like I said, the market generally peaks prior to the recession and bottoms before the end of the recession. So this is kind of showing you that max market pullback over these various recessions. And again, sometimes the recessions can be very shallow. Sometimes it doesn't even enter a definition of a bear market. As we can see in this 1981, it was down 17%, 1960s, 13%. And then we had much more dramatic market reactions like during the global financial crisis when it fell 57%. But as we can see, on average, and it takes them about 18 months to say the recession's over. And as you can see, markets already on average had rallied 43% over that time. And interestingly enough, if we actually look about if your average loss is 30%, how much do you need to get back to even? It's actually about 43%. So on the average, those losses are made up, on average again, are made up in the first year. Again, some are much more dramatic, like the global financial crisis took a lot longer to get back there. But again, this is just to give you some perspective, the volatility we're seeing or may see, or maybe that was just a quick blip and we're on to new all-time highs. But again, this is all to be expected. And but we will all dive into these questions, and I think bring Tim and Paul back on, and we can dive into the questions you guys really want answered here. I just wanted to give you a little bit of perspective.
Yeah, thank you, Adam. Appreciate that. That's great, great thoughts. And just to remind folks, right, is as Adam mentioned, the markets are anticipating kind of where things are going to be 6 to 9 months from now, or at least trying to price in the expectation. But the market doesn't always get it right? It prices the expectation and then it adjusts to the reality. And so even though the tendency at times is to say, hey, what's going to happen, this be in front of it, it's impossible, obviously, to know exactly what things are going to unfold. And especially, right, as we turn now to the next segment, which is more the questions that we're fielding most frequently, we're going to talk about some of these things as far as how, our opinions of obviously how things might be impacted by some of these policies that are coming through. So let's jump into the questions, Paul. I'm going to start with you. So first one that we're frequently answering is, given the current economic uncertainty, what steps, if any, should clients or investors be taking to protect their portfolios? And obviously, how does that factor into what we're doing for folks?
Yeah, no, I appreciate that, Tim. And that is a question that we get often. And I thought about that. There are 3 points I want to make and then kind of talk a bit about a strategy. And the first thing I would say is to recognize the portfolio that you currently have. And this was alluded to by Adam, certainly, but it's a well-structured portfolio. And frankly, it's built for times like this. It's a product of our 30 plus years of research over time of working with others, maybe before you, maybe you've been a client for 30 years, but it's going through Y2K and 9/11, the Great Recession. And you can make a case that maybe this time is different. We'll get to that in a moment. But there's a lot of times when we said that and heard that during COVID, during the Great Recession. So number one, recognize that your portfolio is well-structured, well-diversified, based on our experience in helping others through this time that are typically in retirement, nearing retirement, or retired and drawing income. Second thing that I would say is your portfolio is also, with that same vein, is consistent with your objectives of foundation and growth. And nearly everyone we work with has 3 primary objectives in one form or another. And that's number 1, principal preservation and protection. Number 2, an inflation hedged income. And number 3, growth of capital. And that's paramount in our mind. And of course, when we talk about risk, it's not just risk of loss over the short term, it's risk of not keeping up with inflation. So we want to balance those out very carefully. And also, as we talk about how your portfolio is structured, remember, we're using active managers and not passive indexes. Let me give you a great example of that. Let's say you're in a 60-40 portfolio, 60% foundation, 40% growth. Now, what those managers are doing is within the foundation area, they're investing in a form of foundation or bonds, and we structured that appropriately based on what we call the season of the economy. Second of all, that percentage in growth, let's say it's 60-40. 40% in growth is not just all in the US. And I think that's really important. What we're seeing in the news right now is how the Dow Jones average is doing. Remember, that's 30 stocks. How the S&P 500 is doing. Remember, that's 500 stocks, but it's weighted based on company size. So at one point, the top 7 companies had 30% of the index. And of course, what you're invested in is a well-structured, diversified plan. Many of you may remember that chart called the 20 years of the best and the worst with all those colored boxes. Well, you've got participation outside the US in various companies over time based on our curated allocation that we've got for you. So number 1 is recognize that your portfolio is well structured for times like this. Number 2, I would say, as I answer that question, Tim, is don't let emotions drive your decision or politics drive your decision about an otherwise well-diversified plan. I'm just going to leave it at that because it's so tempting, and we've heard research on this. You may be familiar with it, that what can disrupt an otherwise well-constructed portfolio or well-structured plan to accomplish your objectives is our own emotions. You see what can happen, and Tim, you and I have talked about this, and we've talked to clients about it. We might get out of the market or get out of the portfolio because it's going down. And again, you heard Adam's data there. Well, what happens immediately, you feel pretty good about that. But then, of course, it might go down further, and then you're waiting for an appropriate time to, quote, get back in. And what happens is, and you have to see evidence that you have to get when you get back in. So the portfolio oftentimes will go up above what we got out at, and then we're buying at a high. So just remember, this can be that whipsaw, and we want to prevent that as well. And then lastly, I'd say understand your risk temperament. And if your risk temperament is being pressed, and we want to encourage you because you are all dealing with in different ways, I'm going to suggest very specifically 3 different approaches that we talked about during COVID, talked about during when 9/11 happened, talked about during the Great Recession, and these apply. So it is very specific. Number 1, your objective or the direction or strategy might be to stay the course because of what we've talked about. And we believe that for most folks is the right place to be, by the way. Strategy number 2 is to get more conservative. Maybe you're a 40-60, 40% foundation, 60% growth, and maybe we take that back. So we move part of your growth into foundation. Remember, when we do that, though, we're taking away some of the potential growth in exchange for a bit more preservation. It may or may not work for you in the long run, but it might relieve some short-term concern. And the last approach, number one, stay the course. Number two, get a bit more conservative. The last approach, number three, would be all in the money market fund. Now, if we do that, that again eases the pain, as I talked about earlier. But what we like to do if we do that, we want to have a very specific, systematic dollar cost averaging plan to get back into your portfolio. And if this does test your risk temperament and you really feel this time is truly different, that's when you want to contact us, because we're working for you. We're your fiduciaries. So again, that's how I'd say that, Tim, in this question.
Yeah, thank you, Paul. That's great. Next question that we're, again, fielding quite a bit is about inflation, right? Is how long will elevated inflation persist? What impact will that have on interest rates and investments? So I'll take that one. A couple of things, just going back, just a little set the stage. As we all know, we keep going back to the COVID event, but COVID obviously has a massive impact on obviously policy. And that policy, in essence, of shutting the economy down massively disrupted the economy, the supply chain, all those things that we all remember, unfortunately, too well. But then ultimately, as Adam mentioned, and we saw that big swing in his numbers, right? The market was down 34%, literally a couple of months. Then stimulus occurred, the Fed stimulated the economy, government stimulated, and that ultimately pushed market values way back up, right? Recognizing that the stimulus was kind of softening some of the effects of COVID and the shutdown. Well, as we all know, what happens is when you stimulate massively the economy, it can produce an over event within the economy, and that was inflation that went up to 9.1% in 2022, right? And again, cause and effect. Then the Federal Reserve had to do something to try to quell inflation to get that under control. And what they did is they raised interest rates aggressively, right? So interest rates were at zero. Now rates are much higher. They've come down off of the highs, but still elevated. So the question about elevated inflation is today inflation's around the 3% range. It's not 9.1. Go to the grocery store, though. It's hard to kind of say, hey, inflation's 3 when we're looking at grocery prices continuing to be elevated and other things continuing, more. Think about car insurance or home insurance is going up. Obviously, that's inflationary. But there are parts of the economy, of course, that are going to have sticky inflationary numbers, and we've seen that. But other parts that have come down and have subsided. And so if you look at today's CPI, Consumer Price Index number, it's around 3% plus or minus. So much more manageable, if you will, for the U.S. economy. Now, if you're curious, the Fed's view of where they want inflation to be, their target number is 2%. So we're not quite to where the Fed wants it to be, but certainly better than where it was in 2022. Well, all this to say is that obviously the expectation was that with inflation better controlled, the Fed was going to be able to bring down interest rates. The idea of a softer landing for the economy was very strong going into the end of last year and early part of this year. Adam mentioned the good start to the year that we had. The month of January was up pretty nicely. But ultimately, right, the Fed expectations shifted, recognizing that inflationary pressures were persistent, right? We weren't at the Fed's target. And second is some of these policies, right, that are now coming into the mix, the tariff and trade policy, could obviously unwind that improvement on inflation and actually cause it to go up. Well, now, as you know, the Fed met, a week or so back, they paused interest rate cuts. So now we're kind of in a holding pattern. Interest rates are staying where they are. So we anticipate that interest rates are going to be higher, a bit higher for longer, right? Not at the peak, but a little higher. Mortgage rates, I think, have settled to be around 6.25. They were at 7 or above. Now, this has a positive and negative effect, right? As interest rates stay elevated, that does act as a little bit of a brake to the economy, right? Instead of hitting the gas pedal, the Fed is not braking, right? They're not hitting the brakes, but they're not hitting the gas pedal. They're just letting the car kind of coast, partly because of the unknowns. The Fed does not want to cut rates and then have to raise rates again because inflation persists or moves the opposite direction of where we want it to go. So the negative effect is that uncertainty kind of takes the Fed out of the equation And ultimately, now the Fed is pausing, and we think that that's going to be the case for much of this year. The expectation is still maybe 1 or 2 cuts, interest rate cuts, that is, but it's going to be very measured and very slow. And remember, the Fed is very data dependent. So it's going to be dependent upon the data that the Fed receives down the road on what their next steps are with interest rates. So we anticipate, again, our opinion is that rates are probably going to stay about where they are, may fluctuate certainly a little bit based upon the news. And I'll argue too that that's probably the best scenario for now, because again, if the Fed has to cut rates aggressively, folks, that tells you something's gone wrong with the economy and the Fed has to step in and try to stimulate, right? We certainly, are potentially, right, facing the possibility if inflation moves back up aggressively for various reasons, then the Fed might have to start raising rates. We don't see that at this point. That is a possibility. But we do anticipate rates are going to kind of stay in this range for a while, probably not get radically lower, not radically higher, but about where they are for now. And I think that's a positive, because that tells you something that the Fed feels that, hey, we can just manage things by not really tampering, right? Not touching things, just letting things kind of coast through the system. The good news of this, and as Paul mentioned, right, the diversified part of your portfolio, we call foundation, the bonds. Remember pre-COVID, those bond investments, because interest rates were low, we all remember bank accounts were getting zero, CDs were at zero. Well, with interest rates elevated now, guess what? Instead of our bond side of our portfolio, our foundation side getting maybe 1 to 3% interest, now just the dividend part of those bond investments are yielding 4, 5, 6, even maybe 7%. And so those managers that we have with the relatively short maturities have been able to reset their portfolios, your portfolio, to bonds with higher rates. And so now the next 3 to 5 years, we anticipate that, again, those foundation assets will add more to a diversified portfolio's return. Rather than getting the stability that those bonds provide, we're now going to get, we believe, stability plus a little bit higher interest in that, segment of our plan. So the question is a good one, right? Stay tuned, right? It's an evolving process here. A lot will depend on if the tariff and trade events happen and to what degree, and are they off again, on again. As you know, it's not a linear process here with some of Trump's policies. It's very up and down, on again, off again, negotiating, if you will, maybe even a little bit. But again, our anticipation is with these things still on the table over the foreseeable future, rates are probably going to stay about where they are. We think that's a good thing in essence, because it tells you that the economy is not going into a deeper recession or a deeper dive. And also, too, it's a positive impact on our bond investments, which are yielding higher rates, which is contributing to a diversified portfolio's return. So that's a great question. The next question, Adam, it's going to be to you. So Adam, another popular question: how are U.S. trade policies, including tariffs, right, hot on everybody's minds, continuing to influence our economy? And obviously, where do we see that possibly going?
You gave me the easiest one, right? No,
There you go. Yeah,
no,
the easy
not
ones
quite,
for you,
no.
Adam. There you go.
The hardest one. Yeah, I think that's
I know.
the question the markets are grappling with the most every day. I think, in late January after the inauguration, I think the market started to get a clearer picture of what the idea was, which I think it kind of took the market by surprise, I think, and that's what initially led to some of the sell-off. I think markets thought these tariffs were more aggressive than they had anticipated. I mean, maybe they should have been anticipating that. I mean, Trump does call himself the tariff man. But so I think going into it, that should have been the expectation that tariffs are definitely happening. But I think now, day to day, like even though, as we saw yesterday, the big bounce in the markets, it's because people thought, oh, maybe these are going to be a little bit more targeted rather than across the board tariffs. But again, things seems to be changing day by day. So until maybe April 2nd, we see what happens with these first kind of announced, these delayed tariffs that were announced and then were pushed back a month, seeing in what form do they actually get implemented. And I think that's really what the market is most grappling with. As far as specific industries, I think it's wide ranging, and I think some people are even maybe surprised about, you know, some of the ones that are maybe taking the hardest hit, which would be agriculture. Obviously, agriculture's kind of gotten hit on two things. Some not even having to do with tariffs. Some just having to do with, you know, some cutbacks to the government in general. Think about USAID. A lot of their food was bought by our farmers to go and be distributed to other countries. So that was a huge source of demand for our products, and that was taken away. And then on top of it, countries be putting in, you know, countermeasures on tariffs on us in regard to agriculture. So one area is definitely farmers are definitely taking a hit. You know, they kind of did that, you know, the Trump first term, that kind of also happened as well, but our government came in and tried to support the farmers in that regard to shield them a little bit. How that will go about this time, you know, a little bit unknown. Obviously, automobiles a huge sector, and I think they're all, you know, lobbying for Trump to rescind some of those, and he's kind of tried to piecemeal that together. So and autos are a very interesting one because, you know, some automobiles, because of the way the whole infrastructure has been set up, whether that be with Canada and Mexico, you know, some of these cars are getting hit with multiple tariffs because maybe one part gets assembled in Canada, gets sent down to Mexico, then it gets tariffed again before coming. So we may see, you know, the 25% label, but it could have a bigger impact than that when it comes to going through multiple jurisdictions and those sorts of things. Obviously, temporarily, I think the manufacturers are trying to absorb some of that. Obviously, tariffs are eventually a tax. How those taxes get absorbed is dependent on the industry. Sometimes if maybe the manufacturers don't think that these tariffs are long term, they may try and absorb some of that rather than passing it on immediately. They'll absorb some of that, but that's the sort of them absorbing the cost is actually negative for markets because what that hurts the company earnings. And when you're investing in the company. So the company is absorbing some of those price impacts immediately might be good for the end consumer, but it's not necessarily good for company earnings if they have to absorb some of those costs on their end. So autos and obviously the whole semiconductor area is also a huge impact. Again, how all these things are going to play out, they're moving, changing every day. So don't have an answer, but we do know that this makes companies want to invest less with this uncertainty. No one's going to make a huge commitment to invest when these things are all in limbo. So this is definitely a drag when we talk about overall economic activity and those sorts of things. And while we know tariffs on their own are inflationary, you know, that's just the economic fact of it. The reality is what can offset that though is if tariffs cause, you know, reduced demand, then that could temper some of the inflationary pressures because essentially, but that's not the type of tempering you want because that's just a slowing economy. That's inflation being under control only because of a slowing economy. That's not the sort of, inflation reduction we want. We want to continued growth with all these hiccups. So, you know, too much to be, maybe if we had a couple more weeks, we'd have a little bit more certainty. But as we know, even when the April 2nd date comes, there'll be something that's pushed off again. And so I feel like we'll be dealing with this for quite some time.
Yeah, thank you. To be continued.
Yeah, yeah, exactly.
Very good. Paul, next one I'm going to pose to you. So this is kind of a reflective of, hey, personal concerns, obviously, that clients have, but this idea of, hey, I don't understand the market. I'm really kind of concerned about if my money's going to last as long as I need it to, right? And I think I'll add one other point to this, which is a pretty popular question, is that idea of Social Security and what, you know, is my Social Security safe and Medicare and those kind of things. So I guess the question is, Paul, hey, is my money going to last as long as I need it to? And, some of those concerns about cash flow and income.
Sure, you bet, Tim. And I think all of you, all of you come to us with the whole idea of, hey, we're trusting you all to do the best job you can for us to make sure our money lasts in a variety of economic conditions. And that's very important to us, of course. You've gone through a process. You remember that retirement capital illustration, that long number chart. Each of you have gone through that, where we identify your living expenses on one side, we inflate that, we use an average number of 3%. Then we brought in your income. If you have a pension, we brought in your pension with maybe a different survivorship option, your Social Security. Then, of course, looked at your retirement capital and run that at 3 different adjustment levels. Now, naturally, that's an illustration, not a guarantee. We're very clear about that. But what we've done in that process, and just a little bit of background, that's a conservative look at helping us as your advisory team do the best job we can to fashion a strategy both for investment management and income that's going to best meet your objectives in a variety of market conditions. So that sets the objectives. We then make your investment strategy in alignment with your objectives, and then have a tax-efficient income plan down the road. And of course, some of you are at the age where we're taking the required minimum distributions out at this point, and we're working with that as well. So what I would say to this, Tim, on that, and those that have that question, is number one, that was built with a very conservative view of things, because we want to have a high probability that we're going to achieve those objectives in a variety of market conditions. Second of all, we have an overlay that we do that assumes, for you that are familiar with this, is a Monte Carlo simulation. So essentially, we can overlay that, which we've done for many of you, and look at probability, simulating hundreds of different scenarios, a variety of market conditions, to establish a percentage probability. And that includes the last decade, it includes what happened during COVID, it goes way back. And so we have fashioned this to give a high probability over time that we're going to achieve that in expecting this kind of market. Then also, it's important to keep that long-term perspective. We've all been talking about that. I know one statistic that I've used in some of the meetings I've had with some of you is that if you go back to 1940 and you look at the positive years in a market, because remember that retirement illustration that we've run is not meant to be a year-by-year look at what it's going to be at the end of each year. It's really designed to be a 5 to 8 year time horizon. During that 5 to 8 year time horizon, you can reflect back to that chart that Adam showed. We're going to have a variety of different events happen that will change markets and will obviously change rate of returns annually. But long term, if you just look at the S&P 500, since 1940, about 76% of the time we've had an up market, 24% a down market. The probability is on our side. And then we layer that with the other investments that we have and how we've diversified your portfolio. That, of course, increases that probability, in our opinion, to achieve a positive result. And then, of course, right now, and Tim's alluded to the foundation area, we're getting strong returns right there. And so it gives a little bit of a confidence there, too. So I would say the structure of the retirement capital illustration, very conservative. The other thing I would suggest, too, is one of the parts of our process that we go through is meeting with you all regularly. And as you know, we've got, for most of you, a semi-annual meeting, some it's annual. But the point for that meeting is really to take into consideration any unique changes you might have. In other words, there might be health considerations. Maybe you've got to replace the car. Where's that money going to come from? And it might go outside of the analysis or the illustration that we've done, but we've got a way of capturing that and pushing that out to you and not disrupting your portfolio. And finally, I would say this. One of the other parts of our methodology is we have an investment management process and an income management process. So it's not just a set it and forget it. It's not just a pro rata change or let it go. We use rebalancing, and rebalancing simply means we're carving out some of the profits when we see profits investments do very, very good, like last year in growth, moving some of those into foundation to secure those balances and keep the base there. So we're harvesting those gains. And then also on the income management area, we may be paying out $3,000 a month, $5,000 a month, whatever it's going to be. And most of that may be generated from interest in the foundation, which of course is very secure. And then the rest is actually generated from carefully looking at your portfolio, and maybe it's growth, maybe it's foundation, putting that amount in the money market fund to reserve that for the next quarter's income. So just recognize it's a really hands-on, very proactive approach to the investment management process, the income management process, and also a very conservative look at that retirement illustration that we talked about. But if there's any changes, we encourage you at the next meeting or just to reach out to us, and we can always rerun those as well, as I know we've done with a number of you.
Great, thank you, Paul. So last kind of common question, Adam, I'm going to pose to you, and then we're going to get to your question. So we're going to, if we have your permission, we're going to go a little bit over because again, we want to get to some of your questions as well. But I want to pose this last one to Adam, which is again top on people's minds. This idea of, are we headed towards a recession? And maybe if you could, Adam, talk about stagflation versus recession. I know they're kind of both in the news quite a bit. So are we headed towards recession or stagflation? And, what should investors do, if anything, to protect themselves?
Yeah, I think, this is, markets are definitely grappling with this as well, but I think it, directly related to the whole tariff idea here and in regards to kind of the government cutbacks as well. I mean, if we think about it, the whole tariff uncertainty is causing a lot of delayed activity in regards to companies taking actions, and in regards to the employment situation with the large number of announced, government employee layoffs. That's also factoring in. If we actually look at the first quarter, think about, commonly, recessions are described as 2 negative quarters of GDP. Now, that's not the actual definition of it. As we know, we had 2 negative quarters of GDP in 22, so 2 years ago, and we had a bad market then, but we did not technically have what would be described as a recession. Again, those are dated. Those go on multiple factors, not just the GDP. It has to do with employment growth, income growth, and these other factors. So it's all these factors together. And there's a measure that's actually out there. So a few of the Federal Reserve offices, Bank of Atlanta, Bank of New York, they all come out with their own kind of live approximations of where they think, according to current data, where GDP is tracking. And we actually had the Atlanta Fed, when on inauguration, I think it was tracking about 2.9% for first quarter. That has dipped down to, went as low as negative 2.5%, and now it's tracking at about negative 1.7%. So it's actually, current estimates is that we will actually have a negative quarter of GDP. But there is a big caveat here, because the way GDP is calculated, part of that has to do with the net imports and exports, and there are some nuances. With these tariffs coming up, there's a lot of excess imports trying to get ahead of those tariffs on those products, and that actually caused that import-export to detract pretty largely from GDP. Some of it also had to do with this technical issue with the gold arbitrage and these sorts of things, but a lot of it was basically tariffs and people front loading. So maybe GDP Xing that out is close to flat. But what's not showing up yet, which also goes into GDP calculation, is government spending. Remember, government's not just spending money. That money then gets circulated around the economy as well. And as we're doing these cutbacks and these layoffs, that's another possible detractor from GDP that's not actually showing up yet in the numbers that will be coming down the line. And we then factor that in with the fact that employment has slowed a little bit. We're still adding jobs, but it's slowed. And what also has not showed up is the layoffs that we know are coming. Remember, employment is a backward-looking measure. Before, even for private companies, before they lay off, it's because things have been slowing for a certain amount of time. So when they do officially announce the layoffs, that slowdown had already been taking place. So employment is really a lagging indicator. So I do think, it's not out of the question that there is a recession on the horizon. But again, as we see, when it actually happens, markets may have already been down by a certain amount. You know, we don't know how the markets are necessarily going to react through recessions. And it's important to remember that's why we have a globally diversified portfolio. Not all recessions are global recessions. You know, sometimes it will take one will take another one down. But there are a lot of situations, and think about the tariffs. It's another reason to be globally diversified. There's longer term impacts on these things as well, that, you know, we're thinking about the immediate impacts of these tariffs, but longer term, we do have to think about, you know, if we're doing these, you know, measures against our supposed allies and things like this, if they become less trustworthy of our policies longer term, they may be thinking about making new trading relationships that could bypass the US. But again, while that may be, there's negatives and positives, that could be positives for certain international companies that may pick up increased business. And so there's a lot, you know, it's not a one-to-one situation. There's a lot of moving parts here. I would say, you know, it's really, I think, like most official people putting out numbers are putting it around 30-40%. I think it's the easy coin flip 50% whether we're seeing one, but we definitely have a lot of headwinds on the horizon on the short term. I think the market's trying to look at to see what those if tax cuts will eventually be and how much that will offset, but that's further down the line.
Yeah, thank you, Adam. That's great. So therefore, kind of add-on question to you is that, well, then if it's kind of uncertain, are there changes that should be made to a portfolio given that uncertainty?
Well, I think when we're structuring the portfolios, you know, we really go into it with uncertainty is always expected in our minds. Just think about if we were designing portfolios just for the moment that we were living in and not for the unknown, then you would never be protected against something like COVID or a situation like that kind of comes out of the blue. I would say, you know, everyone's portfolio is made for their end objective. And so just like I said, you know, don't necessarily get on, you know, online and look at the value every time. It's more not a question of what is your return right now, but are you still on track for what your goal is? And I think all of our portfolios, the reason we have these dynamic alternative areas and the foundation is for the uncertainty, whether it's expected or unexpected. If everyone knows about tariffs in this, then it's more likely than not priced in already. It's those things that we don't know about that really are the dangers we should be protecting against.
Yeah, that's great. And the other thing too, I'll just add to that, right, folks, is that, you know, your portfolios, because of the diversification, it's tailored to the objectives that you've set, obviously, which are 3, 5, 8, 10-year objectives. And I get it, people say my long-term is getting shorter, but again, our definition of long-term is 5 years, right? So the idea is that steps that Adam and we as a firm take, right, as it relates to managing funds, which we view as a stewardship responsibility, is obviously putting disciplines in place, right? Those disciplines is, yes, we're controlling what we can control. A lot of this stuff, a lot of these questions, unfortunately, they're outside of our realm of control. So we're focusing on the things we can control, which is well defining the objectives that you've set, right? Each of you have an individual set of objectives, tailoring a plan to your specific goals, having a little bit of a longer term view. We don't take on concentration risk, which is, as Paul alluded to a moment ago, pretty popular these days because those magnificent seven stocks have gotten very popular and that trade has become very crowded. So everybody wants to pile into those names because they're doing well. But just remember, that doesn't mean to say the next 5 years is going to be like the last 5 years, right? And history would suggest that it might be fairly different, right? And so then the other thing too I'll mention, and this is important too to think about, is that realize the response to volatility clearly is fear, and it's understandable. It's a human response. When we're in pain, we want to remove ourselves from that pain. That's just normal. But when it comes to investing, you have to recognize that what we've been doing is trimming areas within the portfolio that have performed well to redirect it to areas that we think are more value driven, right? A little bit more protective, areas that maybe haven't gotten as much upside. And so that's called rebalancing, right? And we do that. We do it externally, but also the managers are doing it day to day within the portfolio. And so instead of being in an environment where volatility creates fear, right? If we're allocated appropriately to your goals, which are long-term, then that volatility actually can be flipped upside down as an opportunity, right? It's an opportunity to pick up great companies at cheaper prices, which then sets the stage for the next recovery, right? So the idea is that, and Warren Buffett said it best, he said, be fearful when everybody's getting greedy. In other words, take some profit and be greedy when everybody's getting fearful, right? That's where the opportunity exists on the extremes, right? And so, again, those are the things that we're doing on your behalf. I say this all the time. I know Paul does as well. Kelly, Georgianne, we do the worrying for you on that front because, again, we're dealing with the minutia of day-to-day stuff. So enough of that. Let's get on to the questions from folks that are listening in. And again, I'll direct it this way. Paul, direct this one to you, right? So it says, we have friends that have frozen their accounts. Is that a good strategy? That comes from Rodney.
Well, I think what that does, great question, Rodney. This is the danger. First of all, is it a good strategy? It depends. And number one, if you can't sleep at night, and I mean almost literally, and this, whether it's politically or economically or whatever, if you can't sleep at night, your health and your well-being is too important. So if it takes a situation where we lock in our values, i.e. moving your money into the money market fund, remember that was one of the approaches that I talked about, then that might be the right strategy for that particular person or couple. But see, what I would do, Rodney, is I'd kind of challenge, if they're sitting in front of me, I would challenge them a little bit. And first, I'd want to see if they're okay with getting a 2 or 3% return for the long term. But then they might say, well, I'm going to rely on my advisor or my intuition to get me back in that market. And I've seen that happen time and time again, where I can get out, I feel relieved, and then you almost get a sense of anxiety when the market starts to go up, because you're trying to find that entry point. And you're concerned because if I find that entry point and drops back down, then you get anxious even more so. So what we found is it really depends. And for most of you, for hopefully all of you, to looking at that portion that has that 5-year plus time horizon. The important thing is to stay the course and use some of the other options that we maybe talked about, which is if you are concerned, certainly call us. Maybe get more conservative. But the concern is, and there's another statistic out there, study that if you miss out in a market cycle, miss out on a very few number of the up days in the market because they're dramatically up, then you've missed out on a high percentage of the increase in that cycle. So I guess I would say it depends, but the difficulty is making two important decisions. One is, when do I get back in? And second of all, do I do it all at once? And what that does, it plays a lot of havoc with the very emotions that you've tried to prevent occurring, which is that anxiety and fear.
Another question that comes from Sandra is some concern about Social Security. So Social Security, there's talk about change, and includes Medicare, Medicaid. So Adam, I'm going to pose to you, Paul, you, and we'll just do a roundtable real quick. So your thoughts on Social Security, Adam, Paul, any worry about that radically being changed or pulled out from underneath clients' portfolio strategies and income strategies? Adam, you first.
Yeah, I don't, I mean, I think change, that's a big, someone to touch Social Security too much. I think that's political suicide, no matter how extreme some policies may be. That's, that's votes out the door. Now, if you try and layer it on over time, push back the age, I think the more reasonable way that I see them doing is just pushing back claiming ages further down. Income limits, those sorts of things, I would see as some sort of ideas that are being tossed around. If she's talking about interruption, though, that's more so because all these cuts that have been happening at Social Security, she's writing about interruption of physically processing these things. It's unknown what's truly going on behind closed doors, how much interruption there is and what sort of systems. I would think that, even that, letting those get delayed would have massive ramifications politically as well. So I think they would, but, it's hard to know what's going on behind closed doors. So, but as far as policy wise, I think it's more things like pushing back long term. It's more things of pushing back claiming ages, having some sort of income thresholds and those sorts of things.
And I would agree with Adam, Sandra, and I'd also say this is politicians by nature want to get reelected. And there's a whole lot of voters that are Social Security age or nearing that. So, and I think there will be some adjustments. We've heard about the Social Security Trust Fund running out, and to the point that Adam made, you can claim it at 62 right now. As we know, that claiming age and 65 to 67 full retirement age, that hasn't changed for decades. Yet the population's gotten older. So it's quite an easy, relatively easy fix, candidly, is just what Adam spoke about, which is just move the age upward. Maybe you have more of your income when you're working deducted from Social Security. There's a threshold right now. If you work beyond a certain number in terms of income, your Social Security, you've reached your Social Security maximum. So it's a very easy, frankly, an easy fix, but politically very, very sensitive. So I think Social Security, in our opinion, is not in jeopardy, although the methodology, maybe there's a means test at some point may be introduced. Certainly, I think the claiming ages would be at some point.
Yeah, and I'll add to that too. I think there's the low-hanging fruit politically, as Paul and Adam both have spoken about, is that, yeah, increase your full retirement age, not for folks that are our client's age, right? But for kids or grandkids, right? Something like that. So why should full retirement age be 67 when life expectancy has expanded, right? So extend that to 72, 75 for younger folks. Increase the percentage of what our contributions are out of our paychecks into the Social Security and Medicare systems. That's low-hanging fruit politically because it's an easy shift, as Paul mentioned, and has the least amount of political pushback and ramifications, quite frankly. So yeah, we never say never, right? I get the uncertainty, but I really, to Adam's point, would say it would be political suicide for politicians to touch that to folks that are a high voting populace, right? Percentage of the populace. And again, to Paul's point, politicians want to get reelected at the end of the day. So again, I think the changes will be somewhat benign. Maybe the processing and again, maybe having to go in to verify your identity, those kind of things. Those are kind of disruptive, of course, but not really disruptive for folks that are already getting the benefits. That's again opinion. A couple more here. Todd asked, as tariffs and have a global ripple effect on the world economies, how does international, Adam, I'm going to pose this to you. How does the international component play into our portfolios and impact on that?
Yeah, I kind of alluded to this before, but I definitely think that's why we have the global allocation, and I think you're talking about as it relates to weighting. Oftentimes of the growth portion, we have anywhere from 35 to 40% internationally. So that includes Japan, Australia, Europe, all over the world. So we're really we're actually quite positive on international, and if we actually look kind of even year to date, that's the area international's kind of struggled in the past to during this short year to date here. It's actually doing quite well, up while we're down, while US is down. A lot of international is up 8% or so. So international has actually performed quite well. And again, as these tariffs come out, it's reworking trade relationships. It's also things like, our pushback against military spending is actually a positive for their defense contractors, as they have a lot of it had been, maybe it could be a negative for our defense contractors because that's less money that Europe is spending on our weapons. And instead, they're trying to internalize this, but that's positive for European contractors.
Yeah, thank you, Adam. So Paul, next one I'll pose to you. It comes from John. It says, I appreciate the guidance and historical perspective based upon the apparent global backlash against Elon Musk and associated impact on his companies. How do we avoid the impacts to our portfolios from this specific problem?
If we're talking about problems with each individual, particularly individual stock, i.e. whether it's Tesla or whether it's something else, one of the things that we are very careful about, and this is why, and feel free to add, guys, to any of this as well, this is why we use actively managed funds, frankly. We're not beholden to one company. We're not beholden to one index. And so we, as Tim alluded to too, we regularly speak to the managers. In fact, we have, it's typically weekly. We have meetings in our offices. So I don't know if y'all know this, but in our offices. So when we have a management company, Generally, we have their presence in our office on a regular basis, periodically throughout the year, and we're questioning and posing questions not just about what we read in doing the research, but we're asking about the rationale they're using to buy and sell certain companies. We're talking to them about tariffs and how they view that. We're talking to them about currency risks if they're global. So I would say the answer I would suggest is that it's an area that I think we need to be very mindful of. And it's also an area that we know that these managers were looking at all aspects of the individual company. And frankly, if they view, and not that this is an endorsement, but if they view there's a company that maybe is a good company that's really underwater because of public perception or because of things unrelated to the economic fundamentals of that company, it's actually a buying opportunity. So these managers tend to look for those things and then act accordingly.
Great. Well, Adam, Paul, thank you for your input, and obviously very timely, a lot of good questions, and we really appreciate everybody's willingness to join us for these. Again, this is again part of a series of events that we're putting out. As Paul and Adam both alluded to, there's a lot of ways we're trying to communicate. Of course, obviously our meetings, certainly that's every year, every 6 months, typically for most of all of you. So those are ways we're trying to stay connected and communicate. Second is occasionally, a couple times a year, Adam does put out in his group, right, market commentary. So those are things that we're going to be pushing out throughout the year as things develop. These events, these educational events are more topical, but occasionally we'll use it for addressing concerns and issues, just like we tried to do today. But then, as Paul alluded to, which is very important, if any of you have any deep-seated thoughts, worries, concerns, fears, don't worry about it at home. Talk to one of us, the advisor that you're working with here at the firm. And obviously, we can either have you come in, we can talk through things, we can talk it over the phone. But again, we are in the process, obviously, day to day of trying to identify the best strategy, best investment allocation that's suited to your goals. The investment managers obviously are vetted, and obviously we talk to them frequently, as we've talked several times about already. So don't hesitate, though, to reach out if there's concerns or questions. We are here for you, and I can speak for Paul and Adam, right? Your interests are our top priority, of course. So thank you very much, and we appreciate your time. Sorry for going over, but great questions. I want to make sure we addressed all of these as much as we could. For those of you that we didn't get to, we'll be reaching out specifically to address your questions, one of our team members. But thank you, everybody. Appreciate your time, and have a great, wonderful day. Enjoy the beautiful weather. Take care.
Take care.